Well, welcome everybody to another Pepperstone live session here. And of course, today we're talking about one of my favorite topics, which is market structure, something that maybe a lot of people look when they're looking at markets. They're always looking for support, resistance, supply, demand, and other concepts. What about if we just went back and said, well, let's have a look at the price action and find out what the market is actually telling us about trend, where we're at, whether we're in consolidation or not. So today we'll be discussing the topic of structure. We'll be breaking it down as we go through the live markets. And of course, we'll start today with crypto, then we'll go through stocks, then of course, we'll go through currencies and commodities as well. My name's Thomas Atkinson. As always, I'm joined by Tyrone Abella. Tyrone, we're close to the end of 2024. It's a pretty exciting time in markets. We're seeing a lot of vol. What are your thoughts over the next couple of weeks?
Yeah, look, I think traders have to be very cautious over the next couple of weeks, because I think we do tend to see as a bit of a rule, actually, a little bit of window dressing, especially in the stocks and indices side. But also, generally speaking, we see a bit of an uptick, and I think that given that we're out of an election year, well, it is an election year still technically. Like, we're going to be moving into January is going to be a very interesting month. I think when the change of government actually happens, that's going to be really important to certainly watch for the market moves. But I think a lot of it's already been factored in. Is it January 20? So look, it's really come up like a storm, hasn't it? Like, we were talking about the election was way back nearly a month and a half ago now, and here we are, only 30 odd days away from actually the inauguration, and then we'll be off under another Trump dynasty. So I think the markets will probably react positively. I think in the past we've seen January it can be a little bit soft, but I think in this instance, I think the market will probably be or maintain its excitement, and that's good for trading. But I think that the best advice we can probably give as traders who have done this many times before, Tom, leading into Christmas, is to be relatively cautious. I think keeping your trades pretty short. I think scalping is the time to be giving you the best results, I think, over this period, over the next couple of weeks, and then probably start to get serious again mid-January. But I think it's going to be a nice volatile 2025. Let's just say that I think there's going to be plenty of trading opportunities, no matter what instrument you're trading.
Yeah, absolutely, there will be. So as always, guys, if you have questions, please feel free to ask them here live. And obviously, we do read your comments as well if you're watching in the replay down below. And click in the link as well so that you can get forewarned for all of our streams coming in 2025. Because as Tyrone alluded to, we do expect a lot more vol. We also expect January to probably be, more towards the bullish side in terms of the data. And then, things get serious, especially in the later half of 2025. So we're very excited for the volatility there and what it could mean for us as traders and investors. So guys, let's begin here with Bitcoin. Now, the reason I want to do this is because I think it's a pretty classic case of looking at a little bit of a difference in structure. So we kind of saw Bitcoin rise up in 2024 early. And then it went into what many people would call a flag or a holding pattern. Now, in essence, this is making market structure. You see a large move, then the market will need to take a rest. And when you're looking at markets, the way you should really be considering them is that it's kind of like a movement from equilibrium to equilibrium. We talk about this quite a lot. We've done plenty of videos on it. So the idea of moving from equilibrium to equilibrium is that we have a fair price. Something then changes, whether that's just supply demand, whether that's news, earnings, something like this. In the case of Bitcoin, whether it's just some kind of announcement from a country or something like that that's coming out. The obviously catalyst here was, in this case, the ETF announcement for Bitcoin. And then we see the market move up, and the market will create kind of like a really quick move, which is like the impulse move. Then we'll often see kind of like a sideways structure, and then we'll see a movement up. Now, pretty much in supply demand theory, this sideways action, once we see a break to the upside, becomes what we call demand. In the case of market structure, what we're doing is we're also asking, how did it get there? What has happened? The trend has gone up very aggressively. As it's making its way up, what it's doing here, Ty, is it's making a series of higher highs and higher lows, but it's starting to compress down. Now, this is what we call a dull market. And you're often taught when you go and do kind of any course, I guess, with a big fund manager, what's the adage, Ty? Don't short a dull market. And the reason why is because the market is taking a rest in terms of structure, but and maybe resetting indicators, but it's still making a series of higher highs and higher lows, isn't it?
Absolutely. I think and people overlook that sometimes, Tom. They see a dull market as
Yeah.
an opportunity that maybe the market's about to sell off.
Yeah.
Generally, markets just sell off. If they're going to sell off, they just generally sell off.
Hmm.
Look, sometimes they give you a bit of a pricing structure that they might be falling away. But when you see that, I mean, that circle right there really tells you all you need to know. Because really, if you go and look at the smaller time frame, yes, we can see after the fact that it obviously shot up, but realistically, there was no signs in any of that circle that would give you the inclination to short. There's no price action telling us that it's turning around. There's no lower high, lower low sequence. There's no break of the 20
Yeah.
moving average. Everything is pointing up, and although it's not making big moves, it's still actually positive, and it's grinding its way up. And quite often, you see this sort of effect just before it actually does go. If, however, it was making lower highs and lower lows and breaking below a 20 and starting to, break the cycle down, that's a different story altogether. But in that circle, we're not seeing that lightning bolt on the way down. That is not happening here, even though you might be starting to get a bit frustrated with it and thinking it could be, for people who don't know what they're looking for in price action, it could be looking like a market that's slowing down and, okay, well, maybe it's about to sell off. It's just a matter of time. There is no price action there that gives us any indication that that's about to sell off. And I think you've got to be very careful because dull markets actually often look exactly like that.
Yeah, well, I bring this up for a very good reason because we're seeing one right now. Now, let's think about what happened, what happened during it, what happens after it. So during this, you're going to get a lot of indicators that said overbought. We've had a huge impulse move. There's going to be a lot of people that want to short it. If actually you bring up even Pepperstone sentiment indicator inside of MT4 or MT5 platforms, I believe it's part of the advanced trading tools component. Again, maybe speak to your kind of like sales advisor or something at Pepperstone if you're interested in that. What that actually will show you is around this point, let's say this was the euro US dollar, or this was gold, or this was silver, or this was something else, or even the S&P 500. I almost bet you that there will be a huge amount of people trying to short it from the retail side. As you mentioned, a lot of people try to front run these. Now, as you know, patience, react, don't predict is one of our big sayings that we talk about here all the time. And in this case, there was no series of lower lows and lower highs. There was no sequence of change. The trend was still up. Now, why I'm mentioning this is we do tend to see these dull markets turn into large explosive moves, and then often they do pull back from that point. So I will come over to the more recent market of Bitcoin, and I think it wouldn't even be arguable to say that that is almost a carbon copy of what we've seen in the other upshoot. So what did we see then? We saw a large move, followed by a dulling market, followed by a large move, followed by consolidation. And why we say this is because we're talking about market structure today. And what I want to get at is that it's not really a pattern so much. Some people wedge it and they call it a wedge or something. It's more of an understanding of the psychology of the market. What's happened? A large impulse move. People are trying to short. But guess what? There is so much demand in this market that the market continues to make a series of higher highs and higher lows. So even when people are trying to short against it, everyone's trying to go against this particular market, it's unable to make a lower low, which tells you in essence there is a lot of strength here, isn't there, Ty?
Yeah, absolutely. It's being held up by all sorts of power. And look, yeah, everyone, look, if you go to the milk bar and buy a coffee or you buy your local bread, people will be talking about Bitcoin again. It feels like, way back in the day where
2021.
everyone was a trader. Everyone wanted to be in Bitcoin. I heard the hairdressers, everyone's talking about Bitcoin. It feels a little bit that way again. And when the market is like that, the buying demand is going to be there, and I don't even think it's just retail. I think there is actually significant money coming into this market now. Um, and don't be fooled into thinking that it could stop at 105 and that's a really big high now. Yeah, this could go anywhere. I mean, people are, I've seen some reports, Tom, there's going to be, what was it, going to be $1 million by
Oh, yes.
2025 or 2030 or something. Look, people laughed at all of the people who were actually predicting 100,000. Way back when it was sitting around the 1,000 and 2,000, there were a lot of people calling 100,000 then. So what I'm trying to say is it doesn't have to stop you. It doesn't have to stop anywhere, actually. So don't be fooled into thinking it must turn around. They're famous words that a lot of people die by in terms of trading. That it must do something. It doesn't have to actually do anything, and that's why it's very, very important that you read the price action and let the price guide you to the next direction, not what you think should happen, because woulda, shoulda, coulda doesn't work in trading. You got to use price to dictate the move, and that's why we always say patience, react, and don't predict. There's no predicting. Good traders, successful traders, don't predict. Okay, they have the patience to wait and react to the market moves. Let the market tell you where it's going, and then work with it. It's the best advice we can give you.
It's really, really important, and that's why we want to talk about structure today. So here we've got the S&P 500. We'll just give a different example, and obviously you could see there the Bitcoin kind of trade, the daily 20 being very important for both Ethereum and Bitcoin right now. And then we come over to the US 500, and I've just kind of circled a couple of periods where we've had pretty dull, pretty slow-looking market. Again, kept the higher high. Again, kept the higher low. In this case, actually took the lower low and then fell off. So again, yes, looks like a dull market, takes a lower low. It's a big difference in terms of structure. And this is why it's very important to understand this. And then this market, of course, ended up rising up and then eventually had the pullback back to that demand zone. So what you're looking for in markets is you're really trying to analyze what you've seen before. Here is a level of demand. Here is a tap of that demand. Here is, of course, a market that's come up to a trend line. It's found a bit of resistance. Here's role reversal. These are all good structure, good ideas. Okay, they're all good different trading methods that obviously do work. But from the structure component, what you're really interested in is you're interested in this component, the dull component. You're interested in the break as it breaks up. That tells you that this is probably an area of interest in the future, which it turned out to be. Here's an area of breaking of the upside. Turns out that that's also an area of interest, support, resistance-wise. And then right now, what are we doing? We're actually creating a new form of structure. We're effectively doing what I call a pit, which is a pullback in time. Now, why is it important to call it a pit when it comes to structure? Well, structure is in essence, well, especially these ones when they're creating sideways, is in essence burning time. And if you think about markets, time is the most important asset or the most important kind of thing in markets, because markets will go up over time generally. And if you give it enough time, if you took 10 years, every single 10, 15, 20 years in between any kind of index, I'm pretty sure if you bought it, except for the Nikkei, maybe in the 1990s, you could pretty much buy it then and hold it for 20 years and usually be up. So time is obviously important. Now, these pullbacks are reset indicators. So you've got to think of, what is this market structure telling us? We are at a market equilibrium. And this market equilibrium is like, you know what? It's a happy level of buyers and sellers. If it breaks to the upside, will we consider this structure if it ever comes back down? Yes. And it's a really simple way of thinking about it, but you've got to just consider patience, wait for the break, wait for the market to tell you what it's doing, and don't get caught up in the chop unless you have a chop-based strategy. That is one that says, okay, one touch to each side. I usually go 1, 1, 2, 2, and then I'll trade it like chop. But generally speaking, the easiest way when you first get into anything, recognize these structures, recognize when they come back, and don't forget about that dull market thing we've just brought up. Ty, any thoughts here on the US 500? I'm thinking daily 20, daily 50 are the two best supports at the moment. About 6K.
Yeah, I love what it's doing at the moment. I think that the 6,000 is going to be, a reasonable support base if it gets there. I'm not even convinced it's going to get there. I mean, I think that the 20 moving average is doing a fantastic job of bolstering this market over the last few months. While it's hovering above the 20 daily moving average, I wouldn't even consider looking at even counter trending this short, because I think that the moves around, you got to remember, around Christmas time, and especially between Christmas and New Year's, like we're talking about the period that's coming up, big investment firms are not trading, right? They're on holidays. So it doesn't mean that the volatility disappears. In fact, the volatility sometimes gets worse, but it actually gets worse on a lot less volume. And what that does is it does very, very heavy spikes. So a short could look like it might be turning around, but it's almost like a false signal, isn't it, Tom? And you got to be really careful that you get, all of a sudden, you think, oh, it's going short, this is the time, and then bang, out of nowhere, you'll see a one-day spike that goes up 100 points. It can happen very easily and on a lot less volume than you think, because the big players are not playing the game at Christmas. I can assure you that is not happening. They've closed, they're out, they're having their Christmas turkeys, and they're not coming in and placing trades. So be really, really careful about even counter trending an aggressive trend that we've seen. This is there's no way about saying that it's not an aggressive trend. We've seen higher lows for months and months and months, and it's at a very key level. We're going into a seasonally strong time of year, and just as importantly, like we said earlier, we're going into a new Trump administration in less than 30 days, or about 30 days. So, yeah, all that information, 6,100 is going to be the point to me. In my perfect world, if you said to me, Tom, what do you want the market to do to make me happy? I want to see it break through and then pull back to the 6,100 and then look for a base off that and then look for a long trade. In my mind, that's the ideal trade. And I'd be aiming for that exact mark that you've put on, which is the trend line extension at around probably 62.50 if the timing is right. That would be the ideal trade. If it breaks the 20 moving average and pulls back down to around 6,000, I'd still cop that because it's a role reversal zone. We know that it's a demand area that will probably pick up trades. We would cop that too. And but again, and we have to stress this, if it does pull back to those levels, what you don't just automatically take a buy there. You want to wait for the market to actually show you a momentum shift on a smaller time frame. Look for the higher low sequences on a smaller time frame, like the 1 hour, 15 minute, or one of my favorites, which is the 4 hour, and then you get that big break to the move up, and that's what we're really ideally looking for here. I wouldn't even consider looking for shorting opportunities on this unless the daily has well and truly closed below 6,000, and realistically, that's what it would take for me to even consider going short, because if we had more lines, we could put lots of lines of text on rules on how we trade, but one of them is don't fight an aggressive trend. That's what you would be doing here if you were trying to short this. That's how aggressive it can be, especially at a time of seasonality strength.
Speaking of aggressive trends, I'll just bring up two if the audience isn't aware of some of the big trends that are going on right now. So obviously we've had a monster trend on Tesla, and this is kind of the classic case of recognizing, again, a market structure that is not negative, which is here, and not going towards the short. So in this case, we have a series of breakouts. We obviously break 270. I'm just bringing this up for Tesla because it's a good example. And we see a market come up, makes a equal higher low, breaks to the upside, no selling, absolutely no selling. In this case, it's also positive gamma, what we use as a options kind of strategy. And you can see here that it is absolutely flown higher. So look, has it detached from some fundamentals? Could you say this is insane? Yeah, but just remember your idea, like that is your opinion on it, is usually going to be wrong, or could even be with limited information. So I always like to say, leave our opinions at the door when it comes to trading, and instead follow the trend and follow what the market's really doing. Remember, there are people with much better information than you making decisions in this market. It's your job as a structure trader, supply, demand, support, resistance, whatever, to basically be able to go with their flow. And you're looking for what are they doing, not what are they saying. And that's why we say if it's in the press, it's generally in the price. Some good kind of like little snippets there.
I haven't used it in a long time, Tom, but it's the old adage that going with the flow. It's like anything, for the majority of users, I'm sure most of you can probably swim. What's easier, swimming, with the current or swimming against it? Trading is as simple as that. When you identify which way the current is going, and by the current I mean the trend and the money flow, if you go in that direction, you're going to have a lot easier day, aren't you? Unless you want to become like an athlete and you want to trade it, you want to go against the current to actually get really, really fit. I don't know about you, Tom, but I don't like putting my money at risk to try and get prove a point or get fitter. I'm very happy to go with the flow. And it is really as simple as that. I know it sounds a little bit corny, but the truth is it is. If you're trading with the money flow, you don't want to be going against it. There is a mentality, especially amongst traders who first start out or who are a little bit inexperienced, where they're always trying to predict the demise of a market or the reversal points of markets. And you know what? We're guilty of that too. We started, when we started way back before the GFC, we were the same. When we thought we'd know when the market's going to turn around, a stochastic oversold or an overbought or all those things. We're always looking for the demise, but we learned over time that actually not predicting the demise and actually going with the flow is the way to be successful. So it sounds like simple advice, but it's probably the best advice that you'll ever get.
All right, well, let's move from those ballistic markets over to one that really is creating structure, and that is, of course, the US dollar. So how do we read this? What are we looking for? Well, we've seen some changes. We obviously saw the downward trend line, which we talked about here live on the show earlier this year, actually later this year, but only a few months ago. Then we saw market break up. Market created a little bit of structure. Again, not making a lower low, which is important to aspect here when you're thinking about this. Then the market basically broke to the upside and finds itself where it is right now. Now, you could argue that this actually is a little short. Now, the reason you could argue that is we've been talking a lot about dull markets. We discussed the idea that the market, when it goes up and it's making these series of higher highs and higher lows, and it's doing so like this, is actually not that bearish. But here we see something different. We see a high, we see a low, we see a higher high, then we actually see a lower low. And in essence, that lower low needs to be investigated. So what has happened around that lower low? Well, it's come down to the daily 20, which we know has been respected here. We know was respected previously several times. We know it's a big key level. We've seen two reactions off this so far. No strong breaks underneath, because again, that didn't actually close underneath this price. And if we then investigate a little bit more, and a structure trader will need to do this because you'll need to look at all of it, you'll notice that when it did dip under this level, it bounced very quickly. So when we go down through the smaller time frames, it's not like it held down there for that long. It's only a 2-hour chart, and it went straight away. So that's telling us that for now, we have to look at this market almost as neutral. Is the trend up? Yeah. Is this structure very important? Absolutely. Would I be short? Probably not. Would I be long? Probably not. I would therefore have the patience in this case to see the reaction. And that's why you're looking for a reaction, a movement to the upside, which will pretty much solidify, okay, we're ready to make that next move to the next equilibrium. Or you're looking for taking out that 105.70, which is exactly where we have this alert for that reason. And if that happens, then where do we expect to go, Ty? Probably down to here.
Oh,
so
back into the 104.20 zone. Absolutely.
But do you agree? I mean, in this case,
100%.
I think the what do you guys in the chat think? Are you bullish or bearish on the dollar right now? Are you neutral, kind of like we are? You know, how are you looking at this? Let us know.
Yeah, I like neutral markets because I think I would be happy to trade this both ways. I'm very comfortable. I'm a little bit the same with gold, actually. I know we'll look at that in a minute, but I don't mind neutral markets that have an unbiased effect regardless of which way they break, because I think I could make a case for this to go to 109 just as easily as I can make a case for it to go to 104.20. And really all it's going to take is a price break either side of what is just basically a giant consolidation. So I'm not biased either way, and that gives me the opportunity to trade whichever way it goes. Sometimes it's not the case. Sometimes it makes only really good sense for it to go in one direction. And at that point, if it goes the other way, I'm not going to get involved because I don't believe the technicals stand up. But in this particular instance on the dollar index, I think that it could swing 200 points either side without any problem whatsoever and without actually having any adverse effects on the market. So I like neutral markets where there's no bias to which direction it breaks to, because you can make a very solid case for both. Because as much as we've plotted its demise below 105.70, we can plot its rise from above 107 with a daily close, and all of a sudden 109 is the target. So and both of them make a lot of sense from a technical standpoint. So they're the trades that we are looking at now. Of course, we can't really talk about the dollar index without talking about the euro. And the euro is trying to rally here. I mean, can we go to the euro for 1 sec, Tom? I'll just talk about it.
We can just before we jump to the euro, just remember the reason why it's also neutral is because the Fed funds rate's about to come out. So if you're not aware of that at the time of this recording, we're about to see the federal funds rate coming, and markets often do this, leading into very important federal funds rate, probably one of the more important information. Will we get the cut? Probably. Okay, yep, here we go. We're on the euro right now.
Yep. So with the euro, it's notice that it's still trading underneath the 20 moving average, right? Like, everyone knows how I feel about the 20 moving average. It's my favorite indicator. And that's for a reason, because it's still doing what we need it to do. It's being held at bay. But the difference is, though, that there is a very, very strong support at around that sort of 104.50 area, right? Really, really strong support. And if it happens to meander on up and close above 106 with a daily and breaks past that moving average, all of a sudden it's almost like a big channel that it's doing at the moment. All of a sudden, that's looking like a long trade, and that long trade can take you all the way to potentially 107 without any trouble whatsoever. That's the next resistance for it. So that's why it pays to be patient with this one, because it could easily swing down if the 20 moving average does its job. Dollar index goes higher instead of lower, like we can potentially foresee. The euro is going to probably get back down to 103.50. And well, it would have to. If the dollar index is getting above 107 and starting to push up to 108, the euro has to go down. It's just how it is. So at this stage, it's a bit neutral too. But to me, it's showing signs that it's kind of getting tired of being sold off. And I think you've got to take that as a bit of a warning sign that we are seeing a very solid consolidation above a very strong level of support, which is a 104.50, but also being held at bay by the 20 moving average. So they're very, very key important points. If you want to basically mark them up as your key zones, wait for a daily break on either side of those. And that really is going to dictate the direction of where the euro is going to go, probably for a couple of hundred pips, really, because the next move is a decent one on either side.
Yeah, and you can see here that on the downside, there's really no major support on the weeklies anyway until all the way down here, as I said, to the 99.50 kind of range in the area down here.
It can go a long way.
Yeah. And up here, 108. So, like, probably a large move, whether it's this year or next year in euro and dollar index, I would say a large move is coming. And that's why we see this consolidation. And that's why when we recognize it in structure, again, some people call it a channel or whatever, it doesn't matter. The same type of thing. You're just basically recognizing the point of equilibrium.
Absolutely.
Let's move over to
I think you've got
gold.
to look at, just quickly on that one too, you've got to look at the left-hand side of the chart and identify what actually generally happens at these levels. And even on the weekly, you could see that when it does eventually break, it's quite explosive and the moves are big. So you always want to make sure that you are looking to the left because generally the past does predict what's going to happen next. That's what TA is all about. And you can see it doesn't stay at these levels very long. And when it does move, the move is quite considerable.
I always say the longer the pit, the bigger the move. All right, so let's now move to gold and have a quick look at this one. So gold is another interesting one. Again, very similar to the dollar in some ways, hitting the 20 moving average, remaining technically on that, obviously making a lower low underneath this little structure here. Still, you could argue bullish on quite a few timeframes. Bit nasty here on the weekly in terms of rejection. So a lot going on, and that's why some people call it neutral. But it's at this area that I've said first bull zone. Now, one of the reasons I say first bull zone is because firstly, we do have a trend that's up. Okay, we have made a sequence that could definitely argue towards the negative side. The same thing is with the dollar is you could definitely be neutral, which Ty mentioned before. Neutrality is not wrong cause here. You guys know me, I do like gold this year and it's been pretty good. So around this level here, we end up getting the most traded zone. So whenever you're looking at structure and markets, you're also interested in where's the most traded. And you can see here a lot of consolidation in this area, a lot of consolidation in this area. And obviously we're seeing consolidation again. Now it's come down. What's a bullish sign? Breaking up here. I'll give you the price so you guys can see it, 27.25. What's a bearish sign? Probably taken out that second bull zone area. Now you break underneath that, could be a large move. So there's really not much to maybe hold this up until down here. But I noticed the reason I wanted to also bring up gold is you can see here this dulling market as it breaks. So this market series of higher highs and higher lows, higher highs and higher lows, higher highs continues up. This is nowhere bearish. This is actually a little bit. There's a very different. So if you went back and you listened to me and Aaron talk this year, and obviously I've been rampant on gold, I was never bearish. I could definitely make a case of being neutral. It's a very different structure. And that's, you may not think so, but when you really break it down, you'll understand, wow, this is a huge difference.
Absolutely, it is. Yeah.
Yeah. And that's important. So I guess I think you already said it before, Ty, a bit neutral on this one. Maybe we can break down oil because it's been a little while since we've looked at oil. What are your thoughts on oil? Has this changed? What do you think? the weekly. So we've got this weird bottoming kind of like crazy level of 60, 50, 58. What do you think? Do you reckon this is looking better now or about the same? Oh, I lost you. Everyone here, Tyrone, just want to make sure. Maybe it's me. Can't hear Ty? Yeah, I didn't think we can. Yeah, all right, no worries. I'll take over then. I've just messaged him. So basically, with oil, no mic. Yeah, thanks, Stuart. You can hear me though, correct? So basically speaking, we've got here structure, and you'll notice again that it's kind of, I would say, like heated off. It has done something interesting recently, though. We've seen a series of lower highs coming down, and then we see a higher high that's formed over here. And you'll notice that then when it pulls back after this, it finds this kind of strong aggression. Now, if you noticed, I don't know if all of you guys follow us, but over at FX Evolution, we also do these videos. And you can see that a few days ago, I went from being the most neutral I've been on oil for ages, and for a long time now, to suddenly saying, okay, it's got a little bit more bullish structure. And one of the reasons why that's happened is because, of course, we broke through this downward trend line and we effectively made a higher high. Now, when we did that, we kind of said, okay, well, maybe we're ready from this consolidation. It's the first early warning sign or early sign that maybe something's changed in oil. And if you had to ask me, would I be more bullish or bearish? I'd always be more bullish on oil right now. Now, is it the greatest setup I've ever seen? No, there are better star quality setups, but this is certainly an improvement here. So this is something that's happened, and you'll notice that those wicks are kind of not lying here when it comes to the daily either. They're actually finding those buyers. So from a scalp or a scalp kind of prospect, and by the way, Ty, if you do hear us, just chime back in, make sure it's working. It wasn't. So yeah, over here we can see there's two strong reactions there. We make a new high. Well, that could open up, getting through 72. We get through 72, we could push 75 a barrel. So more interesting than normal for oil. Still horrible in terms of it's a very geopolitical trade. But notice again, market structure is one of the first ways that you can see a real change of trend here. So I really like that, and I thought it was a good example for us to use here today. So let's go from oil then over to a few other pairs. And again, I'd always like to ask you guys, why don't you give us a couple of pairs? We'll look at them now. So chuck it in the chat and we'll have a look together. Do you think there's something that's made a good structure or it's at equilibrium, or possibly you think it's on a big trend and you want to kind of know where it could be going? We can break that one down and use some of the things we've been talking about today. First up, we will go over to silver. Now, silver has also been a bit of a struggling metal in recent times, and you will definitely be able to make the argument of a classic head and shoulders pattern. That is left shoulder, head, right shoulder. So yeah, we can always. One second. So this is pretty much the classic kind of pattern that everyone will do. Oh, we got you. Yeah, we got you now, Ty. So we just went over oil, but now we're on silver. So we're just talking about the head and shoulders pattern, and I'll just get to mention how important this level will be for silver. And a structure trader is not going to necessarily look at this as say, oh, head and shoulders. But what they will say is they'll say, okay, very important level of support or demand or just an important structural zone. We have seen some buyers come back in over here. They were stopped at around this alert level, which is supply. So again, if you know supply demand, this is supply. And here we have a potential bounce that could be coming in. Now we also could see a sell. So we're going to have to, I think silver will be one that it is going to have a big move on. And it's really at critical zones. This is critical. Will the bulls or the bears win out? If I had to guess, I'd always go with the bulls. But a lot of metals are falling at the moment. And you'll notice here, even the trend line getting pressure put on it. So where do the bulls start to regain strength? Well, let's have a look here at the 2-hour chart. And again, you'll notice this market is effectively dulling towards the downside. So would we therefore buy? No. Would we wait for something to actually happen? Yes. And what would that be? It would be actually making a higher high. And it just hasn't done that. It's been a series of lower lows and lower highs. If that changes, voila, we'll look at it again. So very important level here, and the classic head and shoulders pattern. And I think that a lot of people get caught in these ones, Ty, because we're seeing another one on NVIDIA right now, which is why I want to mention it. And what you'll notice is that it looks great on a daily. I mean, anyone would be able to see this. And they'll all be like, oh, yeah, head and shoulders, kick silver's ass and send it down. But I don't think it's likely. It's not impossible, but it's not likely that silver will generally make this distance outside. So just remember that is more of a probably almost not a recession, but certainly more of a very negative economy sign if that was to happen. We got you?
Yep.
Oh, good.
Okay.
Yeah. So basically that's kind of the way I'd be looking at it. And remember, there are many of these that set up and look like they are left shoulder, head, right shoulder, and you break to the downside. No. Remember that patience, react, don't predict principle we talk about many times per session because it's always worthwhile looking at. And you'll notice here another head and shoulders, left, head, right, break. Still technically hasn't completed. So you just got to be careful with some of these patterns. We do love head and shoulders. They're one of the better patterns. But when they're going against trend, the overall trend, and the trend currently has been kind of bullish towards silver, it does get a little bit more difficult. I'll show you it with NVIDIA. So here's NVIDIA. Now, this actually broken to the downside. You can see here left shoulder, head, right shoulder. And a lot of people are discussing this. Now, funnily enough, NVIDIA is kind of bouncing here today. I couldn't tell you how many people have spotted this one, Ty. And when I look at this as a structure-based trader, I'm always kind of looking at it and saying, okay, well, let's look through the time frames. Let's go up here to the weekly. And again, you could do this on a currency, you could do it on anything. What do we see here on the weekly? We see the 20 weekly moving average. Now, when we last moved below that, we quickly regained it. We did see one dip of it over here in September, but generally speaking, we've held it the entire way up. So that's important to note. The reaction at the end of this week, because this week is actually options expiration week, it's the big options expiration week, this can have a lot of funny business in it. So as a structure-based trader, I'd be somebody looking here and saying, do I really want to take this short? This is a pretty strong stock. Everyone loves NVIDIA. So I always say probably don't want to short strength. That is, you don't want to short the best stocks in the world. Wouldn't you rather short the worst stocks in the world or the worst currencies in the world or the weakest currencies in the world? And I wouldn't say NVIDIA is the weakest stock I've ever seen in the market. What about you, Ty?
No, definitely not. No.
Yeah.
It's one of those ones that you want to be certainly watching, but you know, it's one that you wouldn't preempt, that's for sure. Has it got opportunity to go down? Yes. But is it likely to actually jump off this 20 moving average and push up on the weekly? Yes. So you want to be really careful about taking shorts.
It's one that I think everybody's doing. So everyone's talking about it, and it's because it's obvious. Yeah, it's not. You're not seeing something that others don't see, and the idea of a pattern is often you do want to be seeing some things that big banks are looking at. You've also got to put yourself into the overall trend. If a pattern, and Ty puts this well in our course, the Ultimate Masterclass. Ultimate Trading Masterclass, he puts in, if you see a pattern in the direction of the prevailing trend, that would probably be, in my opinion, and you can tell us, Ty, I'd say it's 2 times, maybe even 3 times stronger than a counter.
At least 3 times stronger. Yeah. If you only took them in the direction of the prevailing trend, the chances of success increase exponentially. It's amazing. So and you beware the reversal pattern. I think many studies have been done on these patterns and they've been found to be around that sort of 50-50, but that's only when they're actually trying to reverse a trend. When they're actually in the direction of a trend, it's somewhere closer to 75 to 85%.
Yeah, it's way higher. And that's really another great snippet for today. We talked about dull structure. We talked about structure and equilibrium. We talked about rejections and stuff. But what about that? Taking structure, or in this case, patterns as well, in directions of trend. If you see structure that is a pullback in time or a consolidation of price, then the consolidation breaks out in the direction of trend, always going to be a way better trade. And I just think that is, I wish I did that when I was doing trading when I was 16. I wish I was doing that when I was in 2007, 8. So, and of course, you do learn these things, but if you take something away and you know, break that down over this Christmas period, and you start to think about it, you look at some of your favorite charts, your cryptocurrencies, your commodities, your currency. You start to look for this structure, understand markets differently. And I think one thing I want to say here, Ty, I mean, a few people were coming through with silver, by the way, and even Nvidia was getting a question mark on it. I think I wanted to say this. You know, many years ago when we were learning so much about TA and we did a lot of these, you know, accreditations around the world, we kind of did this really annoying exercise at the time, which was obviously going out and actually drawing a chart on a piece of paper. So in essence, you were literally dot plotting a chart, and you were putting the highs in, the lows in, the bars, and drawing it all. And what that did was it really made you start to understand, kind of have like almost a, I wouldn't say a spiritual connection, but definitely a connection with the charts in terms of what they were telling you about the psychology of the markets. And in essence, technical analysis is trading the psychology. There was a great quote I heard a little while ago, and it was, I can use all these techniques to basically figure out the markets. However, when I'm really trying to ask the question of what the direction is, I could literally show a chart to a child who is less likely to lie or have a bias on something, and they'll tell me the direction straight away as they see it. And generally, they'll be better at picking that direction than I will, because I would usually be biased. So I think that's a really interesting thing. In this case, what we're doing is we're trying to understand the flow. Tyrone said before, you've got to follow it. You know, surfers know how to use the flow. They go to the side where the rip is. The rip obviously ends at the end behind the waves. So they take the rip on the out back and they don't have to paddle out. So I want to take that. I want to take that flow all the way to the back and not have to do that much work. And I'm sure you guys too. So yeah, a little couple of snippets there, but Nvidia, this will be an interesting one to see how it plays out, because as you can already see, if I was taking a short here, okay, it may work. I tell you what, I'd be a little scared today, because the market just ripped 3.14, ripped the end of yesterday. That is actually found bids, and everyone's talking about it. I always say, ooh, do I want a short strength?
Nope. No, we don't.
All right. Well, that generally brings us, or Tyron says it there. No. So Tyron, that brings us to, I guess, the end of 2024. I almost said 25. It's been a great year. We want to thank you guys for spending your time listening to us. Obviously, hopefully we are imparting some knowledge onto you and you're learning more about markets and hopefully improving. I've had so many amazing stories from you guys on some serious successes in 2024. Some of you have just, you know, absolutely smashed it out of the ballpark through replication and all of those types of things. From Pepperstone, we'd like to also remind you guys, click on the links in the description down below so you can get our 2025 thoughts. We're going to come back bigger and better than ever. And also, we wanted to say that just remember, patience, react, don't predict. You don't build, you know, a dynasty of money overnight. You generally do it putting in the work like anything else. If you want to be the best runner, you want to be the best athlete, you've got to put in the work. We all know this. So keep working on your craft, keep things simple, and don't go looking at this thing that doesn't make sense. If it doesn't make sense, it generally doesn't work in this industry. Just remember that. So for myself anyway, I'd like to say very Merry Christmas to you and your families, and have a Happy New Year. And we'll see you back, I believe, the second week of January. So we're looking forward to that. What wisdom do you want to impart on people before we take a break?
I think the best advice that I could give people going into the next couple of weeks is, if you're hell bent on, you know, looking at the charts, use it as an educational tool and improve yourself and educate yourself over the next few weeks, and then start the year afresh. If you haven't already made a good amount of money trading, you're probably not likely to be making it in the next couple of weeks anyway. So it's the worst time of the year to be trying to actually capitalize. But use it to improve yourself. That's the advice. If you've got a little bit of time on your hands, go to the Pepperstone website, go to the YouTube channel. There's a backlog of, you know, webinars and specific webinars that we've done on topics that we've talked about throughout the year. Improve your favorite techniques. That's the best advice we can give you, because that's really what changed us many years ago. And once you do that, you'll enter the new year with a fresh mind and a market that's going to behave itself far better than it will you know, in the coming days. So I think that's probably the best advice. Work on yourself, but most importantly, take a mental break as well. Enjoy your time with the family, because that's it really is what it's all about. If you can't be doing that, then you're starting the year on a bad note anyway. So I think really take the time out to appreciate what you have learned throughout the year, and brush up on your knowledge to start 2025 more empowered. We can't wait to see you. We really do appreciate all of the attendance that we've had this year, the questions, the regulars. We really do appreciate you giving us your time every Wednesday evening. So we look forward to seeing you again very, very shortly in 2 weeks.
All right, thanks everybody, and I encourage you go have a look at this this little 2018 Australian dollar move, just so you can see what low liquidity over the summer break can give you summer here in Australia. So that basically is why you do want to usually use the educational tools, maybe trade some things over this time. Thanks so much, guys. You have a fantastic end to the year. We'll see you next. Bye for now.
Thanks, everyone.